In the big questions, we'll look at some requests from the comments section of recent episodes of The Big Conversation and try and provide some explanations about what might be happening. And the first one is from a couple of weeks ago from Kartik asking why the euro is going up when the ECB is expanding its balance sheet at a faster pace than the Fed, and therefore why is the dollar going down when the Fed is expanding its balance sheet at the slowest pace. Now this is fairly contrary to the perceived wisdom of dilution. More dollars should mean a weaker dollar and vice versa. But the opposite is happening. Now many people think that just printing dollars is a sufficient condition for a weaker dollar, but not if other central banks are also in the game. But it still doesn't explain why this dynamic appears to be working in reverse today. Over the last few months, we can see that when the ECB balance sheet is expanding faster than the Fed balance sheet, the euro has strengthened and vice versa, including the most recent bout of euro weakness being accompanied by the Fed being the more aggressive. Some people have also pointed out that real yield differentials using year-on-year CPI as a deflator favours a weaker dollar today. The real yield of the US 10-year is lower than that of the German 10-year, but this has only materialised in the last few weeks, and this has been a period during which the dollar has actually bounced. So that's also an unlikely culprit. For some of this year, the euro did seem to be following the actual yield differential for US bonds over German bonds, but that has also broken down in recent days. Therefore, what appears to be in play is not the size of the monetary policy, but the sentiment that policy creates. The euro really started to rise versus the dollar last year, once the EU had passed its fiscal package. The buying of the ECB has also created a backstop for all Eurozone bonds. Yields have been falling everywhere, so that even Greek 10-year yields have fallen below yields on 10-year Italian bonds. Europe is probably being rewarded for the apparent removal of default risk in the periphery. Capital gains can still be made on these bonds, and the need to locate capital outside of Europe has been reduced. As a result, the more that the ECB does, the more it pushes yields lower, providing capital gains for the underlying bonds, which remain at the very heart of European investing, reducing capital flight. So in this topsy-turvy world, Europe is being rewarded for diluting its currency the most, because it comes hand in hand with a backstop for European assets. And the second question comes from Luke, who asked about the consequences of the dollar and US bond yields on emerging market bonds, and in particular India. The main impact will be through the tightening of financial conditions. A stronger dollar tightens financial conditions which are currently near their lows. India is in a relatively strong fiscal position. But what also matters is that many investments into all EM regions have been in the form of dollar exposure from foreign investors. If the dollar rallies, then the value of these investments in local terms will fall, encouraging US investors to take profits and repatriate their capital. This relationship is clearest for the performance of EM equities versus the dollar. When the dollar falls, EM equities outperform, and when the dollar rises, they underperform. EM bond markets will often take their lead from US yields, which are the global benchmark. If US yields rise, investors will again reduce their EM exposure to preserve their capital. This is what we saw during the taper tantrum of 2013. Both EM equities and EM bond funds saw significant outflows and price underperformance. India should still be an attractive destination for long-term capital. The 10-year government bond offers a 6% yield compared to the US at 1.5%. Now obviously this comes with higher risks, both from economic uncertainty such as inflation and currency risk, but many international investors have been eyeing long-term convergence. But in short, EM bonds and Indian bonds are likely to suffer if US yields or the US dollar rally hard from here. At the moment, it looks more likely that if the US dollar rallies, then US bond yields will actually fall. So we should probably keep our eye on the performance of the dollar in the short run. And one of the main things to remember is that these relationships are constantly changing. Relationships that look strong over long time periods can still have short-term periods of extreme divergence. So investors should constantly be checking their own framework for changes.